Oh, by the way, guys, do you guys want to do fantasy football? Do like a real estate fantasy football thing?
I don't follow football, but that wouldn't stop me if you guys
I
want
don't
to.
follow football, but I could try to do the fantasy football. How do you do it?
You talking like American football or like real football?
Oh my god! I can't tell if you guys are with me right now or not.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 10 of Not Drunk Real Estate. I am Kyle Wilson, along with my not drinking co-hosts, starting with Mr. Jay Scott. How's it going, Jay?
I am. I'm going to pretend like I'm not frustrated and grumpy right now. Everything is great. How are you doing?
You're grumpy because you're not drinking.
This is not the drunk or not drunk. This is the grumpy real estate show.
Well, no, it's supposed to be called Drunk Real Estate, and AJ already doesn't drink, which was fine. We need one designated driver, and then Jay's doing a fast, so he's not drinking, and Mauricio's like, oh, it's 2 p.m. I can't drink at 2 p.m. So what are we doing?
Might as well
change the name of the show.
Come on, Mauricio.
How's it going, Jay?
I'm doing wonderful. How are you doing, Kyle?
I'd be doing better if I could ask you what you're having to drink, but I know you just lie and pull some bottle in front of the camera that you're not actually drinking.
And now we all know who are the two grumpy ones in the podcast.
Wow, look at the grumpiness here.
Yeah, I'm calling you out. I'm tired of this
Today,
bullshit.
I am not drinking this Capisco sparkling wine from Italy.
Mauricio, how are you doing?
I'm doing fantastic. How are you guys doing? I am drinking a 2023, or am I just? Did we say I'm drinking vodka? Straight vodka because it's pure.
Yeah.
It's pure. That's what. For those of you on YouTube, this is straight vodka. Kyle, what are you drinking?
Well, we can start with AJ. AJ, I'm sure has some. Actually, he's going to be honest about what he's drinking.
Diet Coke today, straight out of the fountain.
Do you have your own Diet Coke fountain at your office?
I do. Yep, we got our own fountain machine.
Do you? What are you? Coke products or Pepsi products?
Coke. Come on. What kind of question is that?
AJ, how much aspartame do you think you intake on a daily basis?
Whatever is the limit for a healthy individual, I am tenfold above that. So whatever that is.
Well, for those of you who actually care about drinking, I am drinking a small batch 1792. Brought out another good one. So I guess I'll just hold down the whole podcast by myself as per usual.
So you should not be grumpy here soon.
Yeah, I'll lighten up, I guess, after I finish this glass. All right. Well, last week we got a little bit into the trenches regarding the U.S. credit rating when we were supposed to do a bit of an economic update. So let's give this another try with Jay having another economic update since we had some jobs report last week and then everything that went on the week before. So Jay, why don't you start us off?
Are you going to yell at me if I try and talk about something else?
Maybe.
Yeah, he will. You're not allowed to. You have to talk about what Kyle designates.
What I designate, we discussed this in advance. This is a professional podcast.
I had something I wanted to introduce as part of this, and I got beat down.
You literally showed up 10 minutes before the podcast and you're like, oh, I want to change the subject.
I want to add this. Okay, fine. Okay, we're talking about the economic updates because nobody has any idea what's going on in the economy. Let's talk about jobs. We had a jobs report, and jobs came in exactly the way they've come in for the last 862 months. Jobs.
No, it didn't.
Yeah, I mean, it did.
They came in at the lowest level since December of 2020.
They came in at the lowest level, and it was still 187,000 jobs. Unemployment dropped to 3.5%, which is like the lowest it's been in history, tied for what it was a couple months ago, lowest it's been in his history. And wage growth is up again, 0.4%.
And they revised the previous 2 months down another 49,000. Yes, I took notes, Jay. I came prepared.
Yeah, so great. But the point is, jobs are still strong. Nothing has changed since last month. Wage growth was reasonable. We still have 10 million jobs open for 5 million unemployed people. So basically two job openings for every unemployed person. People aren't happy with the jobs that are available to them, but from a macro level, jobs are still really strong. Let's talk about something other than jobs. So CPI is coming out on Thursday. And I think we're releasing this on Wednesday. So we're going to hold this one for a day, but tomorrow CPI is coming out. And the problem with CPI this month is, again, we've talked about the fact that when we look at annual CPI, we average the last 12 months worth of data. And so the new month that we add is going to replace 12 months ago. Well, the number we had 12 months ago was 0%. It was basically no inflation whatsoever, no deflation, just 0%. So assuming the number we get this month is positive, even 0.1%, it's going to drive up the 12-month average. And so I suspect that it's probably going to be a non-zero number this month. So I think no matter what, we can expect that the big CPI number is going to go up from 3.0% come Thursday. Consensus is it'll go up to about 3.3%, which I imagine the media will latch onto and say inflation's up again. But the reality is inflation's not up, inflation's down. And so assuming the monthly number that we see is 0.1% or 0.2%, that's actually a really good number. But again, because it's higher than that 0% that we saw 12 months ago, it's going to bring up the 12-month average. So I hope people won't latch on to that increase in the 12-month average, and we will consider that I think inflation is still probably pretty good. And next week, I will talk about my concerns about inflation, but we're not allowed to talk about that this week. So we'll talk about that next week.
So is the only thing we should be paying attention to at this point then just the monthly inflation print? So like the 0.2, the 0.3, is that all we should be caring about?
No, I think at some point in the next couple months, we'll be over that big hump that we saw last summer, where we saw a bunch of really high readings. Those will be kind of in the rearview mirror. Those won't be factoring into our 12-month average. And I think we'll be getting to a 12-month average where each month is kind of indicative of what we've seen over the last year. I mean, I'm not going to say that inflation hasn't been a little bit high the last year. It has been, but it's not nearly as high as the months we saw last May, June had kind of indicated. So I'm comfortable starting like this month, next month, saying the trailing 12 months has been pretty consistent, and that's a good representation of where we actually are.
And this is one of my pet peeves in general is people like to focus on one data point, and people need to understand that, in even inflation and deflation, you typically have, all of these hundreds, if not thousands of inflationary pressures going on, and the hundreds of thousands of deflationary pressures are going on. And then, whichever pressure is higher will actually move the needle one way or the other. In this case, yeah, the 12-month inflation CPI might be going up or whatever, but why are we focusing on that? Why aren't we looking at the 6-month or the 3-month or just the month over month? I mean, remember, a 0.1 increase in the CPI is a 1.2% annualized number. We always talk about annualized, and a 0.2 is 2.4. So I don't know. I mean, I think you can just look, the data's there. You can see that inflation's coming down. Just because the official 12-month is looking a little higher, that I think people should look a little bit beyond those numbers and look at the trend lines and look exactly what's going on the next 3, 4, 5, in the past 3 or 4 or 5 months.
I mean, yeah, there needs to be some consensus over, okay, are we doing CPI? Are we doing PCE? Are we doing core? Are we doing non-core? Are we doing 12 months? Are we doing 6 months? Because at this point, you're kind of just cherry picking if you want to use what data for what, purpose to support your argument.
Why can't you look at it all, though? That's the idea, is you're looking at all those factors and trying to come up with your best estimate as to where we are today and where we're heading. Because at the end of the day, nobody cares too much. You shouldn't really care what happened, 12 months ago or 11 months ago or 10 months ago. You're trying to figure out what's going on right now and then trying to take that information, project it to the future so you can make intelligent decisions if you're an investor or if you're trying to save or you're trying to spend or where to put your money. You just got to look at it all and make your own conclusions.
Inflation is a number that is relative. Right. So you're right. We have to look at the whole entire ecosystem of economic data. So whether it's 3 or 6, the trend line versus that compared to employment, to asset pricing, this stuff always changes. And the relationship between all of it is what's actually important. And that's why even the Fed changes how they view, okay, well, this number was really important to us on when we would drop rates or lift rates. And it's not as important to us today as it was 10 years ago. Why? Because it's not the same situation anymore, right? So other inputs that go and correspond along with inflation have changed. So the relationship between the job markets, income, inflation, debt, right? All of those things combined equals the overall health. And too often we look at a bottom line number where it's like, once again, inflation, how that affects the consumer, right? Is it bad? Is it good? That's just not how it works. It's a very much a multi-tiered approach. And it's very obvious inflation is down from last year, right? It's down. It's been on a downward trend. Jobs, incomes rising, jobs haven't moved. And that's a good sign. Because what you don't want is inflation dropping, but then all of a sudden you have jobs loss spiking, right, and everything else. But if you have incomes rising and then you have a good job market and we get to a nominal interest rate of below 3%, that means the consumers overall are doing better, right? Now, one of the problems I think that we just have is the increase was so massive that any inflation today is not the same as it was. So last spring, a 6% rate inflation is not almost as bad as a 3 or 4% today, because that would exclude all the inflation increase prior. So a 3% increase today is not the same as a 3% increase was a year and a half ago, because since then inflation has been going at 6-9% every single month. So the point where we're at with inflation, I think, also has to be something that's really taken into account. A 3-4% increase that's still hard for consumers because we're going off just this massive rise in overall prices. So I agree with Mauricio 100%. We got to kind of look at all of these things and how they play together and what that means for the overall health of the economy.
Yeah, and if we're talking about the overall health of the economy, another thing to look at is consumer sentiment. And actually something we've seen positive over the last couple months is that consumer sentiment is up tremendously. I mean, we're still not at like the levels we were 5-6 years ago, but compared to where we've been since COVID, consumer sentiment has gone up tremendously, and that's a good indication that even if we still have, and what you said, AJ, is absolutely correct. I mean, the inflation that we saw over the last couple of years isn't going away. That's there to stay. It's just a question, does it continue to grow? But it sounds like a lot of consumers, a lot of Americans are currently feeling like things are in a better position now than it was, or maybe in a better trend now than it was even just a couple months ago.
Well, one thing I'm concerned with is the ability to take on more. So the ability of the American consumer to hedge and to take on everything from price increases, job loss, the embedded ability to go through certain economic cycles was way more 2 years ago, right? Like the cash on hand and where they were sitting financially, we've really been dwindling down those personal cash reserves and savings rates. Saving rates today are nothing. And to me, that is a horrible sign, because we have inflation, which is lowering. Those cash stockpiles from individuals and consumers have been tapped. They're being drained. And today, they're just not saving money. So the end consumer is very squeezed right now because of that build up in inflation. And it won't take a lot when you're in that position. Like the American consumer was very, very hardy 2 years ago as far as their personal balance sheets went. They're not today like they used to be.
The credit expenditure has also been going up as well. They're using credit cards more and more.
All-time highs. So AJ, you sound like a bit of a downer on that. But then you were saying, a couple of weeks ago that you thought we were doing the right thing, hiking again. Are you still feeling that way?
Yeah, just because the consumers get hurt doesn't mean that's not what's right for the economy.
Yeah, talking about consumer credit, actually just a few minutes ago, I was looking at this while we've been talking. We saw the June consumer credit release was announced. Revolving credit is actually decreased. But non-revolving credit is up a good bit. And so it's actually interesting to look at the numbers over the last few months. We're at about $5 trillion of total consumer credit, up a little bit, but it hasn't gone up nearly as much over the last couple months, simply because while we're seeing revolving credit non-revolving credit increase, we've also seen a decent decrease in revolving credit very recently.
Because you can't afford credit.
Yeah.
I think that's one of the problems we're in. When you look at, you run out of savings, you run out of your stockpiles of cash, businesses do, everybody else, you need to go now get an emergency, sum of money. The prices that today that to get that, it's just not tangible. And
aren't credit card rates at all-time highs right now? Like they're over 20%,
like 25 or 30%, right? Like some of them are obscene.
Yeah, which is that's loan shark level.
Yeah, exactly. And that's the worst kind of debt that consumers could get. And that's what they're left to, right? They're not tapping into home equity because the interest rates are unaffordable. They're not getting bridge loans. They're not, they're really left to credit card debt. And that's the worst kind of debt that they could be taking on.
Well, Mauricio, you should know that. What's the average loan shark rate? What's the VIG these days?
The average loan for credit cards?
No, loan shark rate for.
Well, in my business, we usually charge a couple of big points and 40% per month. Have you guys noticed? I don't know this because this is something that's interesting for me too. Is literally in the last 3 to 4 weeks, I've noticed. At least again, I'm in California, so I'm maybe in some crazy bubble or whatever. But gasoline prices have gone through the roof here. They're up like 10% over the last 3 or 4 weeks. Diesel's gone even higher than that. And I'm just wondering whether you guys think that, we no longer have that much oil left in the strategic petroleum reserve thing, which I know subsidized a lot of those prices last summer. I'm just wondering if that's potentially something that could kick up inflation, because obviously as gasoline prices go up, that permeates through the entire economy, because obviously all the truck drivers need them, all the transportation needs gas. But that's something I'm keeping my eye on. I don't know if you guys, what your thoughts are on the issue of gas prices, because if those start spiking up again, we're at like 550 here in California. We almost got to 7 last summer. But if we go back to those levels of last summer, that could start having those monthly inflation numbers tick up.
Well, that's the problem with not using core CPI, right? Just going off of the normal CPI. And one of the reasons we saw such a low print last time with the 3% as gas prices were down. Well, now we're calling for a 3.3. And I think part of that is because gas prices are back up and it affects that. And they're also saying, if you look at I think the core projections are coming in level, if I'm not correct. Who knows what they're actually come in. Hopefully they'll come a little lower than that. But so if you strip out that gas, then it's a bit of a different story. And as you said, we can manipulate gas a little bit with our strategic reserves. But everything uses gas, right? So
gas is so unstable. The pricing of gas, all it takes is one refinery to blow up in the Middle East to have, a shipping line get tanked. It's like they're so erratic and they follow. It's crazy.
Yeah. So with respect to gas prices, I think 2 big things happened last month. One, OPEC did cut production by about 1 million barrels per day, which is going to inflate prices a little bit. But the other big thing, I think a lot of people don't realize this, is that oil refineries can only work in certain temperature ranges. And we've seen such high temperatures in a lot of areas where we have a lot of refineries that a number of refineries last month had to shut down for a good part of the month. And so we lost a lot of refining time last month. And so supply was throttled because of that. From what I've read, that's not so much an issue right now, but it probably led to the spike in prices that we saw.
Seems crazy to me that there's such a small. I mean, obviously, I believe the margins are so small that it doesn't warrant more people getting into the industry, or maybe it's super regulated. But it sounds like it happens every year. There's a hurricane in Houston. There's something going on, and knocks off a couple of refineries.
Well, from what I understand, these refineries take like 20 plus years to even, make a gross profit on. So if you're looking at where the industry is going, if you're looking at what the U.S. with their policies and regarding oil, like, would you be building a refinery right now?
And this is such a huge issue that's going on because people don't understand, first of all, the sensitivity to oil. And we're not getting off oil anytime soon. It's not even possible, right? It's not going to happen. The vast majority of the world can't even produce green energy enough to cover the basics. We don't have storage capabilities. The United States, we have 1% of storage capabilities. One day, like that's it. And that's in California that has the highest. So the rest of the United States has nothing. So oil is, it's very sensitive to geopolitical structures. It's very sensitive to weather. It's very sensitive to a whole lot of things. And it can really throw things out of whack quickly. And, when you look at, in the United States, we have the oil we need and we have the refineries. All of Canada's oil comes down to our refineries and is shipped out. But I think oil could be a big looming problem that we can have. If we had a problem, it would be with inflation where it's at, where consumers, where the economy is at, oil could easily tip us into a very, very, very bad place.
Yeah, we should do an episode on this topic because, I actually didn't know this myself until a couple of weeks ago, but, even if you go electric, the entire electricity, the way we generate electricity, 2/3 of that is through oil. We literally use fossil fuel and coal in order to, burn stuff and create steam. And that's what actually creates the electricity. So even if we're on an electric grid to create more electric grids, we're going to need oil. I think that's a different topic, but
keep in mind the big electric grids are a whole lot more efficient than a car's generator, a car's engine. So yeah, you do need oil to generate electricity. Unless you eventually get off of oil and onto clean fuels, which
is impossible at scale. Half the world's population, even if you took all the green energy, meaning wind, solar, everything else, the amount of fossil fuels to actually build it would be more than they could yield. Because
that's not true for nuclear. That's not true for nuclear.
Not true for nuclear. That's right. Sorry.
And it's an efficiency thing too, right? Like, I don't know about in your guys' area, but I get a little packet in my area about my electricity, and they offer me to be like, hey, do you want to have all your electricity come from renewable energy sources, like wind and solar and all those things? And then it gives you, if you read the fine print, it's like, okay, your energy bill is probably going to go up 30%. Well, once that comes down to, even, then all of a sudden they're going to start building more infrastructure and it's going to slowly tick that way. And, how many people are actually going to tick that box and say, hey, I'm willing to spend another 30% of my energy bill just so I can say that I'm all renewable?
And you can't, though. That's the thing. Like in the United States, we have the ability outside nuclear energy. The United States is the closest first world country to the equator. The United States has the Rocky Mountains that run north and south, and we have prevailing trade winds that come across. So if you take all of Asia, Europe, all of the renewable energies that they put into, solar, wind, everything, cannot get them off of oil. It mathematically can't happen. They cannot produce enough to even get close to removing them off the necessity to oil without nuclear, which Jay's right. That's really their only option.
Or if you go up other places, there's geothermal and other things too that you could do.
But it still can't produce that amount. So the capacity at which they're running and using energy in today's age, they do not have the means to get it out. So it's a big issue. In the United States, we can actually generate the most, and even then we couldn't do it.
Yeah, I feel like I opened up to finish off, I was just saying, I feel like I opened up a Pandora's box, and if we want to,
it's a great topic.
Yeah, it's a great topic. I'm just thinking we should make a whole topic for next week.
Why don't we push this to another topic? Maybe we could do this next week.
I agree. That's a good, because there's so much we could talk about.
All right, so let's bring it back to AJ here, because AJ's been chomping at the bit to get his self-storage segment on here. And self-storage has been a bit of a darling asset class when the last few years, when investors have seen like massive cap rate compressions, outsized returns. But reports have been trickling in that self-storage is seeing a major rate drop across the country. Historically, self-storage has been kind of looked at that recession-proof or recession-resistant, and so it comes up again now with possibly recession coming. But it sounds like, AJ, maybe the Cinderella story of self-storage is a little bit over with. What's the deal?
Yeah, I mean, it was overdone. So self-storage had the largest rate drop in its history. And self-storage was an emerging commercial real estate asset class that was really going through its adolescent phase. It's now maturing, and it's in a position where occupancy rates have plummeted. And we're talking 30% across rate drop of 30% on average. Some markets way more than that. It's a combination of new supply and two, a fundamental lack of understanding for the vast majority of how the asset class even really works. I mean, over 80% of all syndicators in our industry have come in since 2016. 2016 to now was the largest cap rate drop, as well as the largest rate increase. I mean, it's not even measurable. We're talking 15, 20%. It doubled like twice, rates did. And you didn't have to do anything. Average occupancy from 2018 on was 96%. The next historical high prior to this standpoint was 86% on average. So you had 4 years of an average that had never even been close to seen for an industry. So it was, and I wrote about this 2 years ago about the self-storage bubble, and it was clearly in a bubble. And you can actually see, if I can share my screen here, I'll show you how this burst. And the data is something I think everyone in commercial real estate should be looking at because it tells a lot about supply and demand metrics within real estate. And it gets us a really good picture here. If I can figure this out. Share screen. All right. All right. Now that my co-hosts have their glasses on. So we've got, you can kind of see here the overall rate and, occupancy bubble that we were in that was spurred on from a lot of different things.
AJ, for those who are actually listening to the podcast, you want to maybe describe the charts as well?
Yeah. So the charts show that the rate increase, we're talking from 2020 at $100 went to $190 in just a year. And it maintained those levels, which broke past any norm that we've ever seen. The overall rental rate growth rate was astounding to 60%, which then preceded a total collapse. And that is to the tune of, you're a spread of a 60% growth rate to negative 17% in literally just a year. As we look at the publicly traded companies, we are backed down to transaction levels. So how many are actually being transacted to more closer to 2008, 9, and 10 levels. So the market, both on the customer side and also the market on our actual trading of the asset side, has kind of come to a standstill. So you guys can see the cap rate compression that's taken place. For all of you guys listening, the cap rate compression that has occurred in self-storage for the last 10, 15 years has been pretty outstanding. I mean, you're talking about an industry that an 8 cap was considered low literally prior to 2014 and was commonly 10 plus on a cap rate. So the precipitous fall of the cap rate to under 6%, explosion in value correlated with that rent growth that we've looked at, that led to an explosion of new people coming into the market, and more importantly, a ginormous building boom. And that is what really makes this different. You see, self-storage had not gone through a major development cycle like all the other asset classes that largely took place through the 90s. So all of this is coming to head where you have prices, you have new square footage coming on, and the worst thing that could happen for self-storage occurred, which is shown in these charts. And that's
it's got to be much easier to build self-storage too, like other than like comparatively to multifamily or something like that. Like you're just
much easier.
Yeah.
Much lower barriers of entry. Self-storage had this kind of thing that people thought it was recession-proof. They thought that, oh, this is a really oversimplified asset class, and that's caught with the rate drops because of a few things. But the inputs that drive demand in storage to a large component is housing. And we're in a position now where housing didn't go up or down, it's stagnated. As you can see from this chart, we're talking like, you basically have all borrowers have under a 5% interest rate, with the vast majority, 80+% at under, 3.75, and those are 30-year mortgages. And that's led to just a total divergence in inventory coming down, prices remaining high, and people unable to sell their homes. So this chart here, which is kind of the last one I'll show here, so you can get it. You guys see the assessing home. See if we can get this home sales.
Yes.
Yep.
So you can see here in this chart what everyone listening to the podcast, what we're looking at is the correlation of home sales and move in rent growth, which the correlation is obviously astounding. And this was the thing that everybody didn't get. A lot of people thought if interest rates changed, we would change the value and cap rates. But the big thing that people understand is it would change our underlying driver of occupancy and rent growth. Now, it seems simple hindsight, but at the time, people just didn't see it that way. The reason being is because of 2008, when everybody lost their house, self-storage had high occupancy, and people said, oh, well, it didn't default. But what they miss is the reason why self-storage didn't default is because self-storage had the lowest debt of any commercial real estate asset class. Banks didn't lend to self-storage prior to that. So I'm talking under 50% debt. And most of them had no debt at all. It was a land hold. So they had very low rents, very cheap to build, and no debt. So although they were able to keep occupancy high, meaning 80+%, revenues were nothing. They just kind of collapsed, but nobody defaulted because there's no debt. So it survived very well during the Great Recession. That is not true today. Rents are at high points as a percentage of both income and revenue per square foot that had never been seen. We are also at a point where debt is common and definitely not under 50% in storage. And the 80% of the operators have never been through a down cycle. So their whole premise was predicated on this environment that would never continue. Cap rates falling, rents growing. And that was going to end. So about 2 years ago, we wrote the big piece. We came out with our data. We started to do a lot of things and change how, first of all, we were operating. We moved out of certain markets and we refinanced, pulled tons of capital back in. And right now we're kind of in the heart of it. So storage is contracting. And the Wall Street Journal came out with the article that talked about this as well as others. Now, there's not going to be a wave of defaults for storage. There will be defaults, but luckily storage is sticky. But that whole environment where people could just hang out and they got incredible occupancy rates, they got huge values and huge returns, that's all gone. And it's not coming back for storage. And that's one thing that a lot of people don't understand. It's now a matured asset class, and we can see that in rental rate drop. The reason why a huge push on that rental rate drop was the technology and how we do rental rate increases, because they learned, and especially the big boys, the REITs, they could drop prices so low, they could capture somebody, hold them for 3 months and jack up rates. So now all of a sudden, the technological advantage for these larger operators, it's really big. Yet the cost to build storage is astronomical and hasn't come down. So people that are in the game, if you want to build, you want to get in, we have rent drops, occupancy drops. Performance is just not going to be there like it was. It's not turning around. It's not going to change.
Yeah, but from that graph that you were showing, it seemed like it was very highly correlated with sales transaction volumes of housing. So assuming that we get back to a market where interest rates come down, people start selling their houses, people start buying their houses. It sounds like change of or like the living situation for the average consumer is what spurs self-storage usage. So if we see the number of transactions come back up, won't that just kind of bring you guys back up?
So the problem is where we were at, the transactions on homes is we built an industry. As you could see, prior to '08, we'd never even, we hit $1 billion a few times. We were doing 5x that every single year because they were building according to this huge free money, huge moving rate, huge everything with free money associated with that. So we really overbuilt. We were building to a growth rate. So yes, it will restabilize 100%, but it will not get, and we'll restabilize. We're fine. We're buying a lot. We have to be very specific on markets, but this is an opportunistic play right now because people are in trouble. But when you look at it, you're right, Kyle, it will get back to a normal, but we are not going back to the rental rate increases that we've ever seen, and probably never the occupancy either, because that environment of free money, I just don't think that's going to be around like it was. And that's what affected storage was interest rates at zero, housing, RVs, all of that kind of stuff, which if it did, that would.
Yeah, and you also mentioned the construction costs going through the roof, because I mean I just remember as a syndication attorney I saw a lot of business plans for self-storage, and it sounded like one of the probably the equivalent of the value add play in multifamily was you would buy an existing, if you're not going to build it from scratch, you would buy an existing self-storage, and it had room. It had another acre over here on this piece of land that I could actually go build another 30 units, 50 units, 200 units, and that would obviously increase your NOI. But it sounds like that was a great play with 0% interest rates and construction costs being low. But it sounds like that's gone significantly higher.
We're buying deals today at under replacement cost on brand new facilities. I mean, we're literally we're buying them at $70 a square foot. It cost $85 to identically put it out, and it was just built. So you have those building costs have not come down. So even though you had the rents drop, building costs have not dropped. So it creates this environment that makes it hard. Now, I actually am happy about that because we should see a contraction in the development cycle, which needs to happen. So over the next 3 years, we will balance out because you're going to have less product putting out, and we hope that it returns back to normal, what it used to be. But you're exactly right. Building costs are just sky high for storage.
So anytime you have an opportunity to buy anything, any piece of real estate below replacement value, that's usually a good environment, right?
Oh yeah. And we're in an environment we have not seen since prior to 2013, 14. Our fund that we opened up, we have 3 deals, seller financing. We have off-market deals that are below replacement cost. I mean, these are value add opportunistic opportunities that have just been eradicated and been gone for the last decade. So it's an incredible opportunity. That's why we're super happy about it for storage, because the last 3-4 years was nuts.
How are you determining value on these now, though? Because the thing is, when you're underwriting, obviously you have some projected rent growth. You have projected, okay, what the market's going to do. If you're seeing these huge pullbacks and it seems like it's a little bit of uncertainty, like how are you underwriting the values on these things?
So our underwriting, especially on opportunistic deals, we look at the spread of what's existing and what we could extract from the asset almost entirely. So when I'm looking at it, we have everything from delinquencies, rate spreads. We have revenue management systems that come in, and we're pretty much looking at today. So we're saying this operator's performing at this, they should be at this, and then we're almost flatlining or really watering down those escalation in rents. And we're betting all on what we can pull off the table today. And we're also being very picky about the markets we're in. So we're doing demand studies that are very sensitive, and we're looking at markets that are under replacement cost, right? That do not have burden of new inventory. So upon stabilization, they should retract, and also a stabilized on the rent contraction. So we're looking at those. And so everything's measurable. Now that means way less deals though. So, we bought I don't know, we're at 7, 8 deals for our opportunistic fund, and that's been this year. We thought we were going to buy 30. And there's just, because of that deceleration in rent growth, it's taken a lot of markets out of it. And we're having to be very, very careful on what we can buy. Now, that obviously leads to huge opportunity as things normalize, but we protect ourselves on that downside through that spread. We know immediately we have this much we can extract out of that asset, and that works.
I guess it's good that, it sounds like new supply is kind of taken out of the equation a little bit, so you don't have to worry about that as much.
I just have one last question for AJ. So for the LPs out there that are looking to get into deals, the LPs that like self-storage, what questions should they be asking their GPs before they decide to move forward?
So there's a few things that I'd be very concerned about in this time. First of all, have you ever owned and operated through a downturn in self-storage? It's not like other asset classes. It doesn't affect we don't even have a lot of broad data on it. The second thing would be the overall debt structure. So how are you hedging against market cycles? We lock in for a decade on certain things because we don't know how those fluctuations will work. We're looking at our loan docs saying, what is value? How's that work? And where do you claim? So you need to look at how they're structuring deals first and foremost and their experience. And the second thing is, are they operating it? And have they done it before? Do they have experience? And then how are they going to? What technology platform are they going to use? Are they going to be able to compete? And how's that look at the gate? And look at, like we mentioned, what does your escalation look like, right? Because in storage, it's all about the operator. That's it. I mean, we use dynamic pricing, revenue management systems, complex marketing strategies, and we are a very competitive industry. Every day, people moving in and out. So the strength of the operator will determine how resilient they are, and two, how conservative they are. A lot of people, they want just to make people happy. They make big promises, give out big returns, and they do it at the demise of long-term value. So you need to be conscientious of all those things.
Fair enough. Yeah, it's an interesting topic because I actually had problems finding out a lot of information on it. It's not in the news. It's not something that's making major headlines. When we talked about industries previously, about a month ago, looking at the drops of the different industries, self-storage is one of the lowest as far as cap rates and values. So here you go, bleeding edge information from AJ. It's good to have. Let's move on to let's discuss some more political stuff. Why don't we? It seems to always get a kick out of people. The previous episodes, we talk about how polarized our political parties are. And one thing people seem to agree on, though, is Social Security benefits cannot get cut. Problem is that Social Security is projected to be insolvent. No, they said cannot. That's if you looked at the previous State of the Union, both sides we cannot cut Social Security benefits. But the problem is that Social Security is projected to be insolvent by 2033. So if we aren't going to cut benefits, obviously something needs to change. So Mauricio, what's the best path forward here for us?
Well, first of all, I don't see this as, at least my angle wasn't a political angle. I mean, I hate politics, so I don't think of this as a political issue, though I know it is. I think of it more as an economic issue, right? So we talked about last week a little bit about the Fitch downgrade, and that kind of got me thinking about all this stuff, because not so much about the actual downgrade from Fitch itself, the credit agency, but just the fact that our financials are in a complete disarray, right? We're at $30 trillion in debt, which, is double what it was just in 2011. Our interest payments on that debt are just rising. And we knew this was going to happen, but we used to have interest in our debt at like 2.5%. And now interest rates are at 5%. We haven't, we rolled over the interest payments. It's not quite at 5%, but we're getting close. And we're right now at $1 million, just the interest payments, right? We pay more on interest payments now than we do on our entire, national defense stuff. And so, the solution to that is we borrow more money. We just got another announcement that we're going to be borrowing or basically issuing $2 trillion more the second half of this year. Like the whole year we were projected to do less than that, and now we're going to do $2 trillion the whole year. And Republicans, I guess this is where the political part goes. Republicans don't want to cut defense spending. The liberals don't want to touch Social Security. In fact, nobody wants to touch Social Security. There was a There was a poll out there that said something to the effect of 80% of people out there didn't want anything to change on the Social Security side in terms of cuts, and even for people less than 50 years old. Now, our Social Security age did go up. I mean, it used to be 65 years. Now it's gone up to 67. Last year is when that kind of finalized, and now you retire at 67. You guys remember what happened in France when they, when the lazy French, I apologize for any French listeners we have, but our French friends, I think their retirement age was 62, I believe it was, and it got jacked up to 64, and there were like riots on the street. And so, some Democrats have put on some Social Security reform acts out there, but it's basically to, figure out how to raise more taxes, add, I think the Social Security 2010 Act is looking to raise taxes on quote unquote billionaires and millionaires, as you guys always hear about that, to start doing the FICA, the Social Security tax above 400,000. And then they're looking at introducing a net investment tax of 12.4% on anybody who makes more than 400. Social Security, you mentioned, Kyle, is supposed to go bankrupt somewhere between 2033, I think it was, or 2035. Who are we kidding? That thing's already bankrupt. I mean, what we have there now is we've already rated those accounts. They just have a bunch of treasury bills in there.
Well, not bankrupt, insolvent. So the point is that
insolvent, but we're insolvent now.
In 2033, 2033, we wouldn't have enough money to pay out. So there'd be more going out than there is coming in. So, and we wouldn't have any more reserves. In 2021, we started tapping into our reserves, so they're able to still pay out full amounts. But in 2033, I think it would have to go down to
correct. But when you say reserves, it's not like we have a bunch of cash sitting in an account that we just tap into. We have treasury bills in there. We basically the government's already taken that money from Social Security and replaced it with these treasury bills, which we don't have money to repay. To when those treasury bills get cashed in, we don't have the money for that either. It's this kind of classic Ponzi scheme, right? So I mean, when that time comes, we have to either raise taxes or print more money to pay the treasury bills that have come out. So anyway, the bottom line is it's really frustrating, from my perspective, because it's a major issue that has to be tackled. But of course, there's going to be no political appetite when 80% of the populace doesn't want to change it, even for people less than 50 years old. And this is where I'm going to insert my little opinion here. I'm just having a hard time wrapping my mind around this, because clearly, if you're a retired individual, like my mom's retired, my dad retired, those should not be touched, right? You made these promises to these people. You cannot touch somebody's Social Security that's already getting Social Security. Two wrongs don't make a right. We made these promises we probably shouldn't have, but we can't pull the rug under them. I would even argue that if you're 60 and 65 or maybe even 55 and you're approaching that, again, shouldn't be just pulling that out. But let's go on the opposite side. Like if you're a 25-year-old kid, I mean, it's time to say, look, you're 25. We're not going to give you Social Security at 65 years old. We're going to have to restructure the whole system so that whatever Ponzi scheme we have now, because of course the 25-year-old is paying into a system, that theoretically is for them, but it's really not. It's supporting today's thing. So we have to rehaul the system. But 25-year-old, we should be telling them now that, hey, guys and girls, when you retire in 40 years, don't think you're going to have a Social Security check. And then there has to be some kind of a sliding scale. Like as you go older, if you're 50 years old, you've got 15 or now 17 more years, maybe you're now getting 90% of the Social or 80%. And then just some kind of sliding scale, because this thing just can't go on. It's just unsustainable. I mean, we don't know. We
could fix it right now by just going to 75%, right? Like if we just paid out everyone who's currently getting and future payments went to 75%, our system and all projections would just go back to that's sustainable for the rest of the time.
That's utterly unfair for somebody who's living on Social Security.
I'm not saying that's fair. I'm just saying to use that as a baseline of that's where we're at, is we'd have to cut everybody's 25. So to your point, like if we did a sliding scale back down, we already did in 1983. They already did the reform, and obviously it didn't go over well at the time. But they did, instead of just like, okay, we're going to change the retirement age, they did that phased transition where you can take it early at 60, but then it's the sliding scale up to 67. And they also implemented that all of a sudden before 1983. Correct me if I'm wrong. I think you couldn't tax those benefits, and now those get taxed. So they have made reforms in the past.
1983 was 40 years ago. I mean, if we had actually done something back then and said, look, forget about born in 1983, if you're coming of age 18 and starting the workforce, that you're not going to, when you retire, in 2023, you're not going to have that. That's the time to do it. And I just feel like we're kicking this can down the road. I remember it was actually a Warren Buffett quote I heard. It had nothing to do with the Social Security thing. It was actually to do how to balance the budget. He said, I can fix this thing in 5 minutes. To your point, Kyle, how this gets fixed. It's like, if we don't get a balanced budget, or if you don't fix the Social Security thing by next year, then you are ineligible for re-election. That's the law that needs to pass. If you don't get this thing done, you are ineligible for re-election. Then the politicians would actually do something. But again, with the populace out there not wanting any changes, even for 25 and 30-year-olds, this is just going to, I could just see this train coming down this thing, and it just seems like a nightmare.
Well, I think this is where we need to get creative. And we can say no changes for 25 or 30-year-olds. We can say no changes for 40-year-olds, 45-year-olds, whatever it is. I think at the end of the day, we're going to have to change something. But it doesn't necessarily mean just cutting. There are other alternatives to cutting. There are other incentives. And I agree that, as somebody that's been paying into the system for 30 years and everybody here has been paying into the system, I'm not saying if you could just take away mine and everybody else should get paid, I'd give mine up in a heartbeat. But there are a lot of people that can't afford to just give it up. I think there should be some compensation. Now, I think that compensation, there are other things we can do. We can offer tax incentives or tax breaks. We can offer matching of retirement funds through tax incentives. There are things we can do to help people in their retirement that we aren't necessarily promising them fixed amounts. We can incentivize them to save now for future benefit. And so I don't know what the answer is, but I feel like there's a middle ground in there between not doing anything and simply saying, if you're 30 years old, you're not going to get anything when you retire. And so I think it's important that politicians and more importantly, economists start getting creative and figuring out incentives they can provide that'll be less costly for the government, but will still protect people in 10, 20, 30, 40 years.
That 30-year-old needs to realize that whatever benefits he's losing or she's losing by not now being eligible, they're losing that when more than that in purchasing power, because of all the money that people are printing and your purchasing power going down, that delta is probably higher. So you're actually net losing. You're much better off giving up that money, or to your point, some kind of a program, whether it's a tax incentive or something, to actually compensate if they've been contributing for 5 or 6 or 7 years, or in your case, you're what, almost 60. So maybe a little bit longer. But
can we just get real about this though and say what's actually going to happen? Because what's actually going to happen is we're just going to print our way out of this, right?
Correct. That's my end of it. You can't print our way forever.
It already happened.
No.
It already happened. If you looked at the American Rescue Plan, which was the coronavirus plan, right? That was just to compensate people because coronavirus, the economy, but if you look at that, $36 billion in that coronavirus plan was to bail out in Illinois pension plans. It had nothing to do, it was just because there was a pension plan in Illinois that was really messed up and needed help, and so they just threw it in the bill. And so that's what's going to happen. They're just going to get bailed out. The American taxpayer is going to pay it by printing money, not necessarily just by direct raising taxes, or, to Jay's point, tax breaks, or doesn't matter. It doesn't matter how you do it. Raising taxes, tax breaks, or printing money, we're going to pay for it anyway. And that's how they're going to get out of this situation. They're going to wait. No politician's going to run off of, hey, we're going to fix Social Security by raising taxes or giving tax breaks. No one's going to do that. So we're just going to get to the breaking point, and they're going to print their way out of it.
Well, they are going to. I think they are they are going to do on the tax side in terms of I bet you there's, I know that bill that's there's going to be a significant amount of, and actually an overwhelming amount of the American voters are in approval of, hey, let's just tax the rich, right? Let's add another 12% to people making over 400 or whatever taxes you want to raise, to just kind of put a Band-Aid over this problem and kind of, fill that gap with taxes. But I'm not blaming the politicians.
You could liquidate all the billionaires' money and you still wouldn't put a dent in this. I think people vastly underestimate the size of this problem, because when you look at Social Security, you also have to tie into other things like Medicaid and Medicare. Well, those have been exponentially rising. And the reason being is when you reach a certain age, the overall amount that you take out, right, is concentrated in there, meaning that as society, if you have an individual at the last phase of their life, if you had a bell curve, that makes up 90% of the cost of society. And the problem is we keep people alive really, really well. So what we're doing is every decade that people live longer, we are vastly growing that cost. And it's not a decade to decade thing. You're extending the highest, the 90% of the cost. So now, as these people live longer and longer, the baby boomers, they're not the Social Security aid, the Social Security that they stop paying on that individual isn't going away. So even their projections that they put forth is assuming that people are going to die at a point they're not even going to die.
Well, in 1960, there was 5.1 workers for every retired person too. Now we're at 2.8. So like we're almost half the number of people paying into this.
Yeah, this problem is so huge that the restructuring that will have to take place in society to deal with this problem is going, I think it's going to be a combination. They're going to raise taxes, they're going to print money, they're going to cut benefits, and they're going to have to do it all to try to get to even get the baby.
But when and who though is the thing. Like no one's going to like go out of their way
when
to
they
fix
have
this.
to. You're right, Kyle. It's when they have to. It's when it's such a big problem that it's either not ignorable anymore or it's starting to have.
The longer you wait, the more abrupt and the more drastic change you're going to have to make. If you made it now, you could kind of scale it down, or to Jay's point, you could come up with some creative things to kind of just smooth out the issue or flatten the curve, as you might say. But if you just wait right to the end, then you're going to have to make these drastic cuts.
And that's what they're going to do.
I disagree. I think if Republicans get into office next year, and I think it'll depend on who it is, but I think there's a reasonable chance that they'd be willing to cut Social Security quietly, make some concessions somewhere, and I don't disagree. It's a bad thing to do. Now, I think it could be, if they don't do it well, it could be a political nightmare for them. But again, I think if they get creative, I think if Democrats stay in power, yeah, they'll do nothing. They'll kick the can down the road and we'll suffer for it later. I'm hopeful that if Republicans get into office, they'll figure out a creative way to do it that will reasonably compensate people for the amount of money they've put into the system.
But it's toxic even for them. I mean, if they do something crazy, they're just not going to be reelected. And as you guys know, the number one goal of a politician is to get elected for the next year. I mean, it's just going to contribute to this hockey stick. I mean, this is just, it's 30, we doubled our debt from, listen, in the last 10, 12 years, we've doubled our debt. We're going to be at 40 trillion here in a couple of years the way we're going. And then we'll be at 50 and 60. I mean, the interest that we have to pay on the debt will very shortly exceed all tax receipts that we're getting. And so this thing, I don't know how long, I mean, they can kick the can around up, but it's going to exacerbate the issue of this debt explosion, which is going to be the end of us.
Yeah, the political structure problem we have is that entitlements are, always wanting to be expanded on the Democratic Party. Republicans are a base of old people, right? So if the moment you hit 50 and up, the odds of you being a Republican goes way up. What's the old saying? If you're young and you're a Republican, you don't have a heart. And if you're old and you're a Democrat, you don't have a brain, right? And you look at the demographics and that's how it works. Like old people are just Republican. So then Republican candidates aren't going to go against their constituents in their base because they won't be able to get elected. They'll get kicked out. I mean, some of these states, when you look at like Florida and not Texas, but Florida and some of these other Republican states, I mean, the average voting age of a Republican, because old people also vote more than young people. So they are the driving force of that political spectrum. And that's one of the reasons why this is such a big problem, because the voting class, and the older that they get, the more affected they are by this, are also largely Republican. So you have one party that just wants to expand entitlements. The other one that has the one entitlement, those guys aren't going to cut. And that's their voting basis entitlement. And that's a recipe for disaster because the incentives.
Yeah, I mean, to everyone's point, I don't think we're seeing anything happen anytime soon. Like yearly, they have to do a kind of shore up a report on where we're at, and that came out earlier this year, and no one really wanted to talk about it. Maybe if we have a slower news cycle, maybe that it'll become more of an issue, but I don't see it getting fixed anytime soon. So,
what is the tipping point? Like, I don't even know what that is. What do you guys think? Like, if you guys were to say, what is the tipping point when everybody goes, what does that even look like?
Well, we get to like 2033 was the last projection. It was 2035, and then they're even moving it down. 2033, whoever gets in office in, 2030, then they're going to be like, oh, we got to handle this. Like,
but won't there be repercussions? Like Jay Mauricio, do you think there'll be repercussions? Like, you're going to get to the scaling slope, right? Where it's like, we don't feel the effects of it in the 2033. Like, all of a sudden it's like 26 or 7, it starts to become such a big problem. We can't ignore it. It has more societal effects.
Yeah, I mean, at some point, we're going to have to make some hard decisions, and the American people are going to recognize we have to make some hard decisions. And I think right now we're not at that point. American people just say, well, look, we're spending $1 trillion on defense. We can cut that because, well, we're not directly in a war right now, so nobody's thinking about that. Well, at some point, we're going to cut defense to the point where we can't cut that anymore. And at some point, the question is going to be, do we cut Social Security, or do we cut social programs, or do we cut other social safety nets? And basically, the American people are going to decide we're going to have to give up something that we love, or we're not going to be able to fund our government. And I think until we get to that point, to each of your points, which it's kind of like when it's too late, people are just going to say, well, there's got to be something else we can cut that's less important. And at some point it's going to be clear that there's not. I don't know when that is, but I agree with you, AJ, that it's probably not 2033 or 2035. It's probably going to be a good bit sooner, because I do think that we're going to hit some type of snowball effect pretty soon, and things are going to run away pretty quickly.
Well, hopefully sooner rather than later. And speaking of which, I know, Mauricio, you got to get going. So why don't we move on to the top 10 list? I didn't want to get the top 10 list without Mauricio here, because he needs something to criticize. So top 10 list, since we've been talking about retirement age, I went with the top 10 list of, where's my notes? Top 10 places to retire in the United States. This was put on by the U.S. News and USA Today.
Wow, what a great top! That's an amazing topic, Kyle. That is really wow. That's probably the best top 10 you've done all year.
And just so you didn't criticize it more, I actually went in and I looked at how they rated it, so I could tell you that. So the major categories are happiness index, housing affordability index, healthcare quality index, and retiree taxes. So, and then there's the smaller categories of desirability and job markets and stuff like that. But
we're still going to criticize it.
I know you are. And there's 2 states who are the overwhelming.
We're limiting it to states?
No, I'm just saying, I'm looking at the top 10, and there are 2 states that are the overwhelming majority. So what 2 states would you guess that would be?
Florida.
Belize.
Florida, number 1. Belize isn't the U.S.
Oh.
Florida's number 1. What do you think
Texas.
the second one is? You're never going to guess it.
North Carolina.
Michigan.
Utah.
Alabama.
Number 2 is Pennsylvania.
What?
Pennsylvania?
Actually, Pennsylvania has the top 2 on the list. So number 1, Lancaster, Pennsylvania. Number 2, Harrisburg, Pennsylvania. Number 3, Pensacola, Florida. Number 4, Tampa, Florida. Number 5, York, Pennsylvania. Number 6, Naples, Florida. Number 7, Daytona Beach, Florida. Number 8, the Lone Descent in Ann Arbor, Michigan. Number 9, Allentown, Pennsylvania. And number 10, Reading, Pennsylvania.
Kyle, have you ever been to Pennsylvania? I mean, have you been there?
I live in Pennsylvania, and I've been to actually...
Do you know how cold it gets in Pennsylvania? You know how unhappy people are there?
But apparently people are happy, it's affordable, and there's good health care. And taxes, taxes aren't the best, nor are they the worst. So
based upon the grumpiness index, Kyle, I'd say people from Pennsylvania are not the happiness, or not at that happiness level.
Well, the happiness index was 22% of the calculation. So there you go. So let's move on to finish this up before Mauricio has to get going. And we're going to talk about pizza to start. So pizza, I'm doing a survey here.
He's doing it just to piss me off because he knows I'm fasting.
Yeah, well, that, and actually it's because of the thing that Jay, you showed me on Jon Stewart. That was pretty funny. So we're going New York pizza versus Chicago pizza versus Detroit pizza. And I'll put a small shout out to Philly tomato pie, which isn't going to be included, but that's pretty good too.
I didn't know Detroit was known for pizzas.
Well, apparently it's pretty young, and it's making its way up the list, and I love it. So.
Is Chicago the deep dish nonsense?
Chicago's the deep dish.
Yeah, so it's going to be New York. It's going to be New York.
You're going New York?
Hopefully my wife, who's from Chicago, is not listening to this.
Have you tried deep dish, though?
I'm married to I'm married to someone from Chicago, but I hold the whole family over there. They love deep dish.
Yeah, and if you ordered it right now, you could be eating it in 3 hours when it's finally cooked. Last time I got real Chicago deep dish, and it literally took over an hour from the time we ordered it because that's how long it takes to cook.
And it's not a pizza; it's a pie.
I think I'm still more interested in the bunch of people that Mauricio's married to. I really like to dive into that. Are you from Utah?
I was going to say, maybe I'm from Utah. Maybe one of them's from Utah.
Well, AJ, are you agreeing with them? New York style pizza?
Yeah, I'm agreeing with them.
It's so greasy, and it's like I don't know.
Fold that puppy
Really?
up.
And they gave you citizenship.
I know, right?
There's
Who in the world made that decision?
there's a lot of other states other than New York there, Jay. And they all have
and as we can tell, they all prefer New York style pizza.
not all of them. I'm not saying that I love Chicago. Actually, I threw Detroit on there because I really do enjoy my Detroit pizza these days.
That's got to be the only reason that made the list because I've never heard of that before in my life.
When I Googled it,
I'm going to Google
when I Googled
pizza.
When I Googled it, Detroit came up as a third one. I didn't want to just do one versus the other. I thought maybe someone would pick it, but Philly tomato pie though, huge shout out. Love that.
Oh wait,
love
Detroit
that.
pizza looks actually pretty good. Hold on a second. Wait a minute. Detroit looks pretty solid.
It's like deep dish because it's got the thick crust and it's really like they cook it in the deep dish pan.
Yeah, I'm switching my vote. Dude, this looks amazing. I'm going with Detroit.
Well, I got it. I'm gonna have to try it.
For anybody out there that is even thinking about Chicago style pizza, go watch it. As Kyle alluded to, Jon Stewart did a great rant on.
It's pretty funny. Yeah,
it is very funny. Go watch it. It's worth watching.
His argument is that deep dish pizza is a casserole. It's not a pizza. But
I agree.
but casseroles are pretty good though. All right, so Mauricio, I'll let you go first in case you got to get out of here. You got anything to plug before we go?
I have my every Wednesday. We had Jay Scott. It was our amazing guest last week at Real Estate Syndicator Live on Wednesdays, 4:30 on YouTube. And this week we have Charlie, who is the Chief Investment Officer for Ken McElroy's company. He's acquired over 50,000 units. So we're going to talk about underwriting and acquisitions.
Hey, Kyle, when were you on that for Mauricio's thing? When did you go on that?
On Mauricio's, I've never been on it. I've been on yours.
Interesting. Yeah. Well, okay.
Yeah, geez, never been invited.
Yeah. That's interesting.
As a 3-time guest of Mauricio's show, I can tell you that it's everything it's cracked up to be. So if you ever have the opportunity, I highly recommend it.
Well, Kyle, we know where we end up in the list here, right?
Well, maybe it's because he knows that we need to be edited into like a podcast.
I literally got my first invite to AJ's podcast last week. Finally, just because I'm going to be in. We're all going to be together.
Oh, is that why? That's why AJ's bringing it up this week because now he could say, "Oh, you've been invited to mine."
Got receipts.
Moving to AJ, what do you got to plug for us? By the way, I didn't shout you out at the beginning. Nice looking dinosaur in the back there.
Oh, Ernie. Thank you. Good boy.
We've alluded to in previous episodes that AJ has a couple fossils, but that's the big guy, right? That you have in the back.
What type of dinosaur is that?
So he's an Ionosaurus, which is a relative of the Triceratops. So he's got a big horn that comes out front, 2 on tops that go down. He's one of 7 in the world.
Are those 3D printed, or how do you get one of those?
Yeah, they're 3D printed in the ground.
And they're pretty cheap, right? They're only like a couple $100.
Yeah, they're cheap. I got it off eBay.
All right, what do you got to plug?
So yeah, Fund 2's open up for our storage stuff. We're wrapping that up in the next, I think this month. So that's probably what I'm plugging for our self-storage opportunistic fund.
Fair enough. Jay, what do you got for us?
Oh, we are doing a 3-day apartment challenge, and I probably should have looked up the URL to register, but I'm going to put that in the YouTube notes, the show notes. So I'll put, and of course, you guys always put your stuff in the show notes too if you send it to me. But I'll put a link to it in the show notes for anybody that wants to take their multi-family investing to the next level.
We had a discussion about this, Jay, that we're actually firing you as being in charge of, and AJ's team is going to take over. So from now on,
in terms of marketing,
no, just running the podcast. Because when you just left in the middle of the podcast, and we just said, "Wait, We're gonna keep going. We saw you left, so you're losing that privilege anyway. Once again, go follow my wife, Badash Investor. She started actually reposting my shorts too, so even more of a reason to follow her if you want to see some more shorts of what you're already watching. All right, gentlemen. My drink is gone. I think it's time to hit the head. Are we going to do next week Thursday? So I
We
will
have to figure that out.
All right. Well, I'll see you either way. I'll see you next Tuesday or see you next Thursday. It works either way.
See you guys.
See you guys.